Technological innovation in the market for financial services has given rise to new products, new delivery channels, and most importantly, new providers such as BigTechs. These developments are the source of a number of opportunities. Still, they may also present certain risks that need to be addressed by appropriate policy action. In the case of BigTechs, most of the risk arises from their ability to leverage on a common infrastructure, notably large amounts of client data that help them gain competitive advantage in a wide variety of financial and non-financial services by creating substantial networks. Big tech business models entail complex interdependencies between commercial and financial activities that can lead to an excessive concentration in the provision of both financial services to the public, as well as technology services to financial institutions. Consequently, big techs could pose a threat to financial stability in some situations. Now, the challenges these specific models pose for society, as I understand, cannot at this point in time be addressed by the current regulatory requirements. So when it comes to financial services and technology, what is going to be the right way to regulate the tech industry? Well, this is what brings us here today. Hello and welcome to today's discussion, Regulating Big Tech in Search of a New Framework. My name is Maclean and I'm co-founder of Regulation Asia. Last month, the Financial Stability Institute at the BIS published a new paper outlining options for regulating big tech. And in today's discussion, we're joined by the authors of the report, as well as a special guest to discuss how big tech poses risks to the financial sector and the approaches to regulating them and the specific proposals made in the paper. Joining us in our expert panel is Fernando Restoy, Chair of the Financial Stability Institute at the BIS and co-author of the report. Johannes, a Senior Advisor at the Financial Stability Institute at the BIS and co-author as well of the report. And Lloyd, a former banker, regulator, as well as a co-author of the report and contributor to Regulation Asia. He's joining us from Singapore. And Douglas Arner, the Kerry Holdings Professor in Law at the University of Hong Kong. Digital finance is a key area of his focus. He's obviously based up in Hong Kong. Now, before we kick off the discussion, just a little bit of housekeeping. Please do send your questions along the way. Just use the Q&A box and we'll try and address them as we go along. For those of you who haven't yet seen the report we're referencing, we'll try and email you a copy of the report after this session to make sure you're up to date on everything. So with that, I'd like to kick off today's discussion and ask our panelists to maybe help us understand the motivations of the paper. Fernando, what are the risks from your perspective that big tech poses to the financial sector, and why has this become an issue for the BIS?
Thank you very much for the introduction, and many thanks also to Regulation Asia for organizing this event, which allows us to present some of the work that we have been conducting over the last couple of years on policy implications of the growing participation of big techs in finance. So at the BIS, we started looking at these issues like around 3 years ago. Some of you might have seen our 2019 annual economic report, where a whole chapter was actually devoted to analyze the business models of big techs. That work led to the introduction of the big tech DNA concept, or in other words, the acknowledgement of the network externalities that big techs create by leveraging interaction between the data, the D, network, the N, and activities, the A. So this is precisely the combination of activities that big techs perform, what generates data on clients that can be used to improve and enlarge the set of services they provide, that progressively attracts more and more clients, which in turn generates new data and so on. So the Financial Stability Institute, or the BIS, we focus our work on the potential risks for financial stability that this very unique business model can generate. Of course, big techs also bring many benefits to the financial system, but as regulators, of course, we have to pay special attention to the risk side of the equation. In particular, we identified 3 sources of risks. The first and possibly the more direct source is obviously the provision by big techs of sensitive financial services, such as payments, credit, or credit underwriting, or wealth management. But unlike regular financial entities, big techs perform those activities in combination with other non-financial activities, you perhaps actually pointed out before. Those financial activities being e-commerce, social media, IT services, etc. So that generates obviously operational and contagion risks and create internal conflicts of interest. Many of those financial services are sometimes offered in cooperation with traditional banks. For example, they recently announced a partnership of Apple with Goldman to offer a deposit account. But sometimes this is done through quite opaque arrangements. The second source of risk is the provision of critical technological services, such as cloud computing services, to regulated financial institutions. And that creates very material operational risks that can easily become systemic given the concentration of those services in a few big tech providers. And third source of risk is that network externalities that big tech business models create. Those externalities create incentives for data misuse and sometimes abuse of positions of market dominance. That may trigger fast concentration dynamics, which may challenge not only market competition, market contestability, but also trigger an excessive dependence of the financial system on services provided by only a few players, thereby increasing its vulnerability. So those risks, it is probably one of the most important messages we want to convey in our work, is that those risks are quite specific of this very singular big tech business model. And as such, they require quite a specific regulatory approach. So let me stop here, Brad.
No, I mean, it's interesting. You've raised all of those risks, but Johannes, I was wondering, I also noticed interdependencies of those risks were a key issue also raised in the paper. Johannes, could you maybe elaborate a little bit more on that?
Yeah, sure. Thanks, Brad. No, maybe let me give you a bit of background to earlier work at the FSI and interdependencies, and this is to complement what Fernando has already said. So now, we realized last year that there are many questions around the inner workings of big techs, and it was not entirely clear how they go about the business. No, the issue is that the platforms, the digital platforms of big techs are visible, but what is behind it, what makes them work, is very hard actually for outside parties to understand, and outside parties include, of course, financial regulators. No, so a critical question in this regard is how do all these financial and non-financial entities within the big tech groups work together in the ecosystem, and the outcoming, the risks that this collaboration entails. Now, so this is kind of, one is about these interdependencies and between entities within the big tech group, but the other issue is, of course, how big techs work with external partners in providing their financial services. And then, as Fernando mentioned before, there's also this issue about big techs providing technology services, and this is the cloud computing discussion. That is also creating some potential challenges. So earlier this year, we looked into these issues, and the outcome of this work was a paper that we published in July that is also on the BIS website. And here now we tried to identify common features of the big tech's business model, but also the risks that come out of this. So, and what you see here on the slide, and this is probably stating the obvious, is that big techs now provide many different services. So we were able to identify three main types. What we called core services. This would be, for Rakuten or Alibaba, this would be e-commerce, or for Google or Baidu, online search. Then you would have financial services, and this is to complement the core services and also allows big techs to collect additional and also different types of data on their users. And here now, I think it's quite known already that big techs move into finance, started with payments, but soon then they expanded into other sectors of the financial industry. And then lastly, we have the tech services, and here, as I said before, some big techs have become indeed critical providers of these services to both financial and non-financial institutions. So what we've also learned by looking closer into these issues is that the combination of all these activities creates interdependencies, both within a big tech group, but also with other external partners. And maybe a few words on the intragroup dependencies. Now here, the point is that big tech platforms are powered by multiple legal entities, and they work together within the ecosystem. They share data, they use common technological platforms to provide the services. So they have a lot of dependencies with each other. And then on the other hand, external interdependencies. And here, this is what Fernando has just mentioned. Now we have this multitude of partnerships that BigTechs have with existing financial institutions. And these, they range from performing front-end functions, but could also be co-providing financial products and services. Yeah, and then lastly, also part of the external interdependencies is the critical role of BigTechs as providers of IT services, in particular cloud computing. Here, maybe one interesting finding we had is that not all BigTechs actually provide these services, and especially the smaller, more regional players, they also rely on the services provided by what we term the global BigTechs. So there are also a different shades of grays there. And maybe lastly, a few words on the risks, and Fernando already alluded to them. Now, for the intragroup dependencies, there's this issue that if you have a problem in one part of the group, that this problem spills over to other parts of your group. No? And for regulated financial entities, this could mean that there's a problem that emerges in some part outside of the regulatory perimeter, but then this affects the regulated entity within the BigTech group. Now then, external interdependencies, of course, when you partner with somebody, there are always different risks involved, and it include operational risk, but also risk to your reputation if anything goes wrong, consumer protection risks. There could also be issues around moral hazard if incentives are not aligned, and things like that. In the cloud computing space, of course, if you have only a handful of big techs providing these services, this creates single points of failure and also a kind of concentration risk at the technology services level. And as we all know, the market for cloud computing services is highly concentrated, and latest estimates show that the top 4 providers control around 70% of the market. So to wrap up, no, we don't think these risks are fully captured by the current setup, and this is also why we have thought further about what we could do about regulation.
So it's interesting. I mean, it's clear that we don't believe that the current setup covers a lot of these risks. But I guess before we delve into the different approaches in addressing these big tech risks through regulation, I mean, Douglas, I noticed a couple of the names on the list there. I think you've done a lot of research on yourself, like the likes of Ant and Amazon. I mean, from your perspective, would you agree with the assessment? And could you talk maybe a little bit more about the benefits you've seen from some of these big techs?
Yeah, thanks for that, Brad, and great to be on this call today and the discussion. I think this is an issue that really everywhere around the world is focusing on, both in the context of big techs and data generally, as well as in the context specifically of financial services. And I think in some ways we have to frame this as part of some bigger trends. And, you know, I think if we think about technology and data, as was mentioned by Fernando, we often talk about network effects. And network effects mean that the more customers, the more data, the more users, the more actually benefits to all of those users of the platform. That's the platform economy. But the challenge is that it benefits not only the customers, but it also benefits the operator of the platform. And you have this tendency towards what we always describe in tech as winner takes all or winner takes most models, where you end up with a single or a dominant player. And I think, as Johannes highlighted, when we think about the big tech firms, it was only logical that as they think about their database businesses continually looking to expand, that they would particularly move into things like payments and e-commerce, which were a logical add-on to the services they were already providing, and using that same sort of platform model. And I think what's been interesting, if we look at some of the examples of, say, Ant or Amazon, has not just been the benefits on the side of payments, but particularly from the side of SME and individual access to financial services. If we think about one of our core problems, our grand challenges in financial development, financial inclusion, it's always SME finance. And the fact that all of the various approaches to SME finance have always been relatively unsatisfactory, particularly vis-a-vis the benefits from the standpoint of growth, employment, innovation that we see from SMEs. And amazingly, that sort of mass data model, using that as, some would call it a form of collateral, others might think of it as a form of reputational analysis or even cash flow based analysis, or combining all three into an automated tool that makes small amounts of money easily accessible to large numbers of SMEs that didn't previously have access to finance. And I think that has been one of the key huge benefits in the context of BigTechs in finance. But there's also another big picture trend. And that is, if we're thinking about 2008 financial crisis, 2008 was all about systemically important financial institutions, all about too big to fail. And what we've seen really over decades is likewise tendencies towards concentration in the context of traditional financial services. And in many cases with digitization, that has increased. We can see it particularly in the context of asset management, in trading, as well as in banking. And not surprisingly, when you combine those sorts of network effects of tech and economies of scope and scale in financial services, you get this tendency towards dominance, which is beneficial in many aspects, but also raises a whole lot of risk. So I think the key point is thinking about how do we get the benefits of data aggregation while minimizing some of the risks of concentration and dominance that seem to come with those in a purely market-based model.
Okay, I mean, yet again, just following that thread in terms of you've mentioned that many firms are already being licensed for payments or money services or even credits, for this financial inclusion maybe, but essentially non-banking financial institutions. Fernando, I mean, we often hear about entity versus activity-based regulation. And what has now, I guess, some kind of catchphrase, the idea of same activity, same risk, same regulation. But yet again, if I'm reading between the lines in the research, it seems that you're skeptical about activity-based approach. I guess before we discuss the specific approaches outlined in the paper, how do we get here?
Yes, thank you, Brad, for this question. You don't have actually to read between the lines. You have to read the lines of different pieces that we have actually written, and certainly we are quite skeptical about relying only on activity-based regulation. And indeed, it is the case that in the regulatory debate, particularly a couple of years back, it was often stressed by the banking industry for sure, but also by some regulators, that the regulatory response to risk posed by big techs active in finance should actually focus on ensuring that they are subject to the same regulation as other, say, more traditional providers. This was indeed the origin of this slogan. The first version of the slogan was very clear: same activity, same regulation. And it was obviously accompanied by claims in favor of a more activity-based regulation as opposed to an entity-based regulation. Indeed, we are quite concerned about this way of looking at the relevant issues. First, because from a conceptual point of view, from a pure conceptual point of view, activity-based regulation only makes sense if all entities performing a specific activity generate the same risks. But this is not obviously always at least the case. For example, think about credit underwriting. Certainly, risks are not the same when this activity is performed by an entity that can only use their own funds, like a mutual fund or private equity, than when it is performed by commercial banks, funded with deposits taken from the public, which are subject to possible bank runs. So in other words, I think there are risks that are associated not to specific activities, but to a combination of activities, like in this case, giving credit and taking deposits, that characterize this combination of activities, characterize some entities, like, for instance, banks. That is why banks are subject to banking prudential regulation, but other entities are not, even if both can provide actually lending. The same logic should be applied to BigTechs. Already now, in order to offer financial services, say payments, they need to hold specific licenses, like a money transmitter in the United States or a money institution in Europe. And also they have to satisfy the corresponding activity-based regulation. So you can say that the activity-based risks are already covered. The concern should now be the extent to which we don't have sufficiently regulatory control to address the genuine risks that emerge from running a business model that combines different financial and non-financial activities within the same group and rely on common group-wide technological and data infrastructure. So it's about the combination of risk associated to the different activities that BigTechs perform. So to the extent that we don't have yet those effective regulatory controls, we need to introduce those missing controls by establishing a specific, therefore an entity-based approach to regulate BigTechs, as we need also a specific but different entity-based regulatory approach for other institutions like banks. So this is actually our take on this. It's not that we actually have to rely only on entity-based regulation, but certainly that we have to complement the already existing activities-based regulation with some entity-based regulation for BigTechs that will take into account their quite unique business model. So let me leave it there, Doug. Sorry, Brad.
Wonderful. I mean, Jamie, following on from what Fernando's just mentioned around the current state, I guess, of big tech regulation, I mean, what are the generic approaches you've identified in the research?
Yes, well, if I could just add on to what Fernando's mentioned, is that big tech are subject potentially to the current frameworks. There are sectoral frameworks in place which are developed over time to deal specifically with banking, insurance, and investment or securities risks. And if a bank if a big tech is engaged in such activity, then they'll have to be licensed. They'll be subject to prudential regulation and supervision at the individual legal entity level. Now, it could be that if there's more than one such entity in the group, those rules could be extended on a consolidated basis. But we don't think that happens in big tech, because in order for that condition to be fulfilled, there needs to be a common financial parent or financial holding company. So those rules are very limited at an entity-based level, at the individual level. We've mentioned the activity-based regulation for activities like payments and in some jurisdictions lending, etc. And then there's another group of financial activities which are unregulated that we mentioned in the paper as well. And these could also be carried out by a big tech, and we're thinking of things like buy now, pay later lending, perhaps, or digital asset servicing. So there's a whole array of financial activities, some of which are subject to some type of framework, some which are not really subject to any framework at all. And that is the basic concern that we have, that this is a patchwork and piecemeal approach to dealing with these risks, and they completely fail, or to a large extent fail, to address the interdependency risk that Johannes mentioned a little earlier. That's the intersection of the non-financial and the financial activities, and that's where we think the nexus of the risks and the value that big tech creates is located. So that's the main concern. So what we've done is we've in the paper summarized a few of those shortcomings, and I think you can take a look, or the audience can take a look. They're really in the terms of scope of application of the current rules, the powers of supervisors, to regulate the risks and oversee the risks in a big tech model, and a general lack of transparency in terms of the rules that are being applied to big tech at the moment. So part of the problem is we don't actually know how these enterprises are run and where the value is emerging and where the risk is emerging. So having made that argument in the paper, then the paper moves on to look a little more closely at the interdependency risk, particularly how the current frameworks deal with non-financial entities, non-financial risk. And this is an area where it differs from jurisdiction to some extent, and some of the approaches are more developed than others. But I think we have a slide at this point that I could refer to. These are our own terms that we have created, or labels that we've created, and we've identified three generic approaches which we perceive to be latent in some of the frameworks, but could also be developed. So the three are restriction, segregation, and inclusion. They could be effective in their own right or in combination. And if I could perhaps briefly say a couple of things on each. So restriction is effectively the prohibition of the coexistence of financial and non-financial business within the same group. And this is achieved sometimes by placing severe restrictions or limitations on the financial institution from engaging in any commercial activities whatsoever. And it could also be extended to the owner or the controller of the financial institution. For example, in some jurisdictions, the owner of a bank would be deemed to be a bank holding company, and therefore the rules would be extended to the activities of the BHC as well. In contrast, segregation allows for the coexistence of the financial and the non-financial activities within the same group under the same parent, but these activities have to be structurally separate. And once you have reorganized your group into different silos, then that allows for some degree of ring fencing and firewalling so that data can't cross from one side to the other, financial exposures can't cross from one side to the other. And then finally, inclusion, and by that we mean a way of bringing the financial and the non-financial activities to coexist within the same group, but to bring them within a single regulatory category, which allows for the application of controls and obligations at the group-wide level, particularly in relation to those interdependencies that we mentioned earlier. And segregation is the approach adopted by the Chinese at the moment. There are advantages and disadvantages of each. You can see the in the slide there that we think that restriction potentially impedes innovation, even though it's a very simple thing to implement. We think that segregation does create transparency and isolates the risk, but ultimately may underappreciate the contagion risk of the group. And then finally, the inclusion approach is perhaps the most comprehensive, maybe the most difficult to implement, but is also perhaps the one which encourages or facilitates innovation the most. So I'll pause at this point.
You mentioned that China and the forced segregation approach there. I'd like to come back to that in a moment. But Fernando, I mean, from your perspective, is a prudential focus appropriate for big techs?
Of course, in order to answer this obviously relevant question, we have to discuss what we mean by prudential, right? So we have to be clear about the meaning of this term. We believe, as we have explained already, that big techs pose risks for financial stability, and for that reason should be subject to specific regulation. Some people will consider that all financial stability-related regulation could be considered prudential. We prefer, however, in our definition of this term, by applying it only to core regulatory tools in banking and insurance, such as capital and liquidity requirements. So if we use that narrow concept, we believe that in general, prudential requirements are not essential to properly address risk posed by big techs. The reason being that big techs, while active in financial services, do not necessarily have a predominant financial focus and are not normally heavily exposed to solvency issues arising from risk transformations, as for example, banks do. Actually, rather than on purely solvency issues, we are much more concerned about financial stability risks stemming from complex internal operational interdependencies that we have already described, and also insufficient incentives BigTechs have to preserve data and consumer protection and adequate market functioning. But we believe that those risks, which are again related to financial stability, could be best addressed by limiting those interdependencies through the segregation approach that Jamie just outlined, or by introducing a specific group-wide requirements under the inclusion approach. So there are ways actually to address those financial stability risks without necessarily sort of considering imposing some sort of capital liquidity requirements at the group-wide level. But I think hopefully we'll have an opportunity to further explain this. Thanks.
No, that makes perfect sense. But I just wanted to go back to that Jamie's comment on China and the forced segregation. I mean, Douglas, I'm sure you saw also in that table at the start that they referred to Ant's group. As I understand, a lot of your focus has been researching China. And as I understand, China has, from a policymaker perspective over the past couple of years, focused in a very high-profile way enforcement actions against some of the largest domestic technology firms. Douglas, from your perspective, how has China's approach evolved to contain technology risk?
Yeah, thanks for that. Actually, I wanted to frame a little bit this group and activity discussion, because it's something that I think we've got to keep it a little bit in the context of focusing in on exactly what we're talking about here, which is big techs. And of course, if we think about this broader question of non-financial ownership or control of banks and other financial institutions, this is a discussion that has a very long history. 19th century in the United States, if we think about this region, Asian financial crisis, very much focused these sorts of intergroup relationships. So that's something that this discussion about non-finance owning, controlling finance, this is a long-term discussion. What's different with the big techs is often the scale that we're talking about. We're often talking about something that has a much different scale than a sort of industrial group or a conglomerate that we might have been talking about before. The second is this aspect of tech. And all of us in the sort of digital finance space in the 10 years after 2008 up to COVID had endless discussions about this question of, will the little fintech startups come in and disrupt traditional financial services? Will blockchain and cryptocurrencies come in and give us an alternative to our centralized world of finance? And much of this discussion of activity versus entities approaches came up in the context of how should we deal with new startups, small institutions that were coming in, often focusing on one specific activity. And the argument was very much that what we didn't want was to force some of those new startups, new entrants to comply with a full banking regulatory requirement. And so I think the key to this activity versus entity base is really a framework that we've been using for a long time, which is around size, scale, interconnection. We use a framework, at one end of the spectrum, you've got too small to care. At the other end, you've got too big to fail. And somewhere in the middle, too large to ignore. And as long as you're down at that small end, probably less regulation is going to be more appropriate. But as you get bigger, more interconnected, doing more stuff, then you're probably moving into some sort of entity-based system. And as you move towards these issues of too big to fail, too connected to fail, new systemic importance, that really takes you into sort of full group-wide sort of supervisory issues. And, really you're thinking of a framework that I call a proportional, graduated, risk-based approach, which means that you have to look at whatever it is pretty closely to determine how it is. And I think China provides a very interesting example of how this evolution can go. If we look at Ant starts out 10, 12 years ago as a startup. Yes, admittedly, it gets an important asset from Alibaba, its parent, in the context of Alipay. But of course, Alipay in this period a decade ago was much less significant than it is today. But they then take that and the fact that largely they managed to set themselves up to operate in largely an unregulated framework, which allowed them over time, quite intelligently in the way they built the business, to build a network of scale of data and financial services, which they applied not only across payments, but to asset management, to credit, and eventually your sort of full group-wide basis. And I think by around 2018, 2019, there were some questions about size. In other words, by around 2018, not only did you have the scale of Alipay, you had Yuebao, which had emerged by that point as the world's largest money market mutual fund. Ant had emerged as the second largest issuer of asset-backed securities in the second largest asset-backed securities market in the world. It had emerged as the second largest provider of SME credit, and they were looking at essentially building this out. And so there was a real question that, one, was it starting to have some of those scale risks of the traditional financial institutions? And a real debate that is decided very clearly in 2020 that yes, it does, and that it needs to be regulated as a sort of financial holding company, bringing together all of these various subsidiaries in the same way that we would treat a traditional financial institution. And I think we've also had, not only in China, if we look at it, we can really see it coming from three directions. One is the financial regulatory side, basically trying to determine at some point it goes from too small to care, to too large to ignore, to too big to fail. And the related point that we're thinking about regulatory arbitrage. Second point is around competition. The fact that not only did they have data pools to dominate most industries, but they were actually selling the data to everyone else, which in turn reinforced data dominance. So we see a second track around data laws and data regulation, and a third track, which is really around concentration and dominance, basically antitrust and competition law. And so I think if we look at China, we have to realize, one, that this had a tremendously positive impact from the standpoint of the digital transformation of their financial system, of their economy. But at some point, it began to have some negative risks, some negative assets. And the approach is one that is not just about financial regulation. It's about financial regulation. It's about data regulation. It's about competition and antitrust regulation.
Very quickly on Ant there, based on your scale from too small to care through to too connected to fail, where would you see their focus beginning at Ant? Was it because it was too big to ignore or too connected to fail when they started to focus a lot more?
You know, I think that Ant had individual pieces that became quite large. And the key to the success of each of those pieces was leveraging the data pool and the platform model. And at some stage, it became clear that, you know, there were questions both from the standpoint of potential risks in the payment side, in the credit side, in the shadow banking side, for that matter, as well as this side from potential constraints on competition and dominance. And I think what is interesting about the Chinese approach is not just the combination of these different sorts of regulatory strands, but the key focus on data as a sort of public good and how to open that data pool to other companies to power industry going forward.
Johannes, I mean, Douglas has just kind of walked us through China's multi-pronged regulatory approach, as well as the concept you mentioned of, data for good. I mean, can you share us a little bit about the EU approach and objectives?
Oh, yeah, sure. No, yeah. So, I mean, we've heard Douglas now talk about China's approach. So, in China, as you know, I mean, as Douglas just explained, BigTechs have become quite dominant providers of financial services now. So here I would argue that it is not surprising, therefore, that the Chinese authorities have also focused on ensuring financial stability and putting in place a number of initiatives in this policy area. Also because of that scope and scale that Douglas just mentioned now. So the situation in the EU is a bit different. Here, the EU, of course, is a large market for BigTechs outside from Europe. So this is, of course, one different aspect. And one might say that because of that, also the EU's approach is focused more on kind of controlling the perceived risks that these BigTech activities bring to Europe, but also at the same time trying not to reap the benefits that one might see to consumers and businesses. So, I mean, in the EU, there are several policy initiatives that have been taken in different policy domains, and I may only mention a couple of them in the area of competition, operational resilience, but lately also starting in financial stability. So, in competition, now you all know that the Digital Markets Act has entered into force a couple of weeks ago, and will start to apply in about 6 months. So the DMA, this is about protecting the contestability of markets in which so-called gatekeepers are present, and gatekeepers are defined in the Act as large and systemic online platforms that fulfill certain criteria. No, so because of that definition and how it is set up in the DMA, I would argue that these are kind of entity-based requirements for BigTechs, and the idea is here to constrain the BigTechs activities ex ante. No, and this would be kind of to complement the traditional ex post enforcement of competition law. So basically, the idea is you already put in place some constraints before actually it's too late to act under the umbrella of traditional competition law. So then in the area of operational resilience, now the proposed Digital Operational Resilience Act is on the table, and that might be more of an activity-based initiative because it imposes no requirements on the security of IT systems that are used in financial services. So here the scope is very broad. So almost anybody now kind of being involved in financial services would be captured, and this includes also BigTechs. But on the other hand, one interesting element in DORA, and that is now the new regime for critical service providers, which would entail additional requirements for these cloud service providers and also direct supervision. So if you're BigTechs providing cloud services, you would face additional requirements and also be subject to additional and direct supervision under DORA. And then lastly, in the area of financial stability, I may only mention the European Commission's call for advice that was issued in February last year. And here the Commission requested the ESAs, European Supervisory Authorities, not to look at the existing regulatory perimeter and to see whether what we have right now is actually enough to capture the risk from the involvement of platforms and tech firms in finance. So and in response, no, the ESAs replied then earlier this year, and they issued a report that offered a detailed analysis, I have to say, on the limits of the EU frameworks, especially in the context of financial conglomerates and what they call mixed activity groups. So so this is a quite interesting report if you like to read up on regulation. but no, they have a number of recommendations in it, and one of the recommendation I wanted to highlight is the recommendation to review the existing consolidation rules, and they also talk about the creation of a bespoke consolidation rules for groups that conduct both financial and non-financial services. So a lot of initiatives going on, but then there are also others that I haven't even touched, like the Digital Services Act or the Markets in Crypto Assets Regulation, MiCAR. So I would say the EU is quite active, so it's all moving in the right direction. But of course, EU bodies can only legislate at the EU level, and whereas BigTechs at the end of the day have a global business model.
So you've just commented on the recommendation for bespoke regulatory framework for BigTechs. I mean, Fernando, can you describe your thoughts on how the framework you expect should be developed, and how practical are some of these recommendations?
Yeah, so this is again to maybe the core part of our latest contribution, our paper. I think that under the inclusion approach that Jamie already described, of course, all regulated subsidiaries will still need to continue satisfying the requirements that are imposed in the countries where they are incorporated. We don't actually propose any modification in relation to this. So what is really new in the approach that we are actually proposing is the introduction of requirements at the group-wide level for BigTechs, which are considered to have significant financial activities, what we call BigTech financial groups. And the parent company of those BigTech groups should be made responsible for satisfying those group-wide requirements. So those requirements to be imposed at the group level will cover essentially three areas, right? The first area is governance. So rules should aim at ensuring that the group's corporate structure allows the identification, the control of potential destabilizing the interdependencies and conflicts of interest across different subsidiaries within the group. As we have been describing in this conversation, it's very clearly spelled out in the paper, those interdependencies, those risks stemming from the combination of activities that the BigTechs perform should be the focus of the regulatory action in relation to BigTechs. So the second area of requirements to be imposed at the group-wide level is conduct of business, right? So that includes requirements on issues like data use, data protection, and data sharing, but also competitive behavior and business ethics, because all that actually have implications for financial stability. And the third and a crucial area actually in our proposal is operational resilience. So BigTechs should be able to assess and properly manage all relevant intergroup interconnections. Importantly, the definition of risk tolerance levels and the planning and testing of operational safeguards should be conducted not only at the level of the different regulated subsidiaries, as it is currently the case in some jurisdictions, but also that should be conducted as well at the group-wide level. So, as for traditional group-wide prudential requirements like minimum capital at the consolidated level. So I said before, we don't feel that in principle we need actually to impose this type of consolidated requirements for most BigTechs. We feel that those prudential requirements should only be imposed actually for those BigTech groups who currently satisfy actually the requirements to become one of those categories like financial holding company or mixed financial holding company that are currently subject to consolidated capital and liquidity requirements. Otherwise, we feel that if we are actually stringent enough in imposing actual requirements in terms of governance, conduct of business, operational resilience, certainly we should be able in principle to address most of the risks that actually BigTechs could generate, and considering their very unique business model.
Jamie, I mean, are there any other conditions that we should be taking into account for financial stability or risks or competition issues that need to be addressed?
Yeah, well, what I would add to what Fernando said is that this category of a big tech financial group is not meant to be applied to all big technology firms. We in the paper suggest that this should only be applied to big techs that have a significant engagement in financial services. So the natural question might be, what do we mean by financial services and what do we mean by significant?
Yeah.
And that goes back to Douglas's point, I think, on too big to ignore, too small to care, to too big to ignore, to too big to fail. At which point do we capture, or should we think about applying this category to big techs? And the way we thought about it is that there's no single prescription or test that we can think of, but we suggest a few ideas of considerations. And some of these apply at the level of the firm or the group, and could look at the extent to which their balance sheet, their total assets, might be referenced to financial sector assets or financial assets, or the percentage of their revenue. This could be an absolute measure or a relative measure. But we also think that there ought to be an element of macro prudential perspective that comes into play here. So the extent to which maybe a big tech is dominant in a particular market for a particular product should also be a consideration. But I think it's complex. There are probably multiple thresholds and multiple tests that would need to be applied. And the difficulty is actually striking the right balance between clarity for the industry and flexibility for both the industry and the supervisory community as well. So it's not an easy question to answer, but we give some ideas of how to put this definition together of a financial group.
Johannes, I mean, I'm just reflecting a little bit on Doug's discussion around China. I mean, from my understanding, China is a very domestic market versus Europe, which you walked us through, is far more cross-border in nature. And if we look at most of the global big techs, you know, their business models are cross-border. From your perspective, should we be aiming for a consistent supervisory approach globally? And if so, how do we determine the responsibilities of one, the home, or the host regulator?
Yeah, thank you for this question. Indeed, this is a very important question to answer. And I mean, we believe that the approach that we put forward in the paper is actually fully consistent with the existing home host division of regulatory responsibilities, and we don't think it would require any significant changes to this structure. But maybe let me try to explain a bit further by looking at an example. So I have a slide to show. Yeah, perfect. So in the chart you see here on the slide, this presents the distribution of responsibilities between home and host authorities for a big tech group that is active in different financial and non-financial activities in more than one jurisdiction. So under the proposal we've put forward in the paper, we would see the home host division as follows. So starting at the top, so here, we would say the country where the PTFG, the parent, where the parent operates. This determines then what home country requirements apply to the PTFG. So this would mean that group-wide requirements for the big tech parent would be the responsibility of the home authority, and this is fully consistent with what we have right now also in banking. So in this example, moving one level down below, all financial activities performed are grouped into a financial holding company in each jurisdiction, and this legal entity would be subject to host country prudential rules that it would also have to satisfy on a consolidated basis. So other rules, of course, like AML CFT from the host country could also be imposed on that entity. And that then at the bottom, for regulated entities that are active, say in payments, insurance, they would have to satisfy the sectoral requirements in the host countries. So this is also in line with the current regime. And lastly, for the unregulated entities like e-commerce or entities engaged in lending, now they would be subject to more general obligations like data privacy or competition or consumer protection, again in the countries where they operate. So meaning host authorities would have responsibility here for enforcing these requirements. So this is on the general structure in terms of how we see the division of home host. But maybe let me also say a few words on supervision. And here, I mean, the logic of this new regime that we're putting forward is that it should address these interdependencies and risks from different activities and the combination of these. So therefore, ideally, you would have a single authority that is in charge of monitoring these rules. And the rules that are imposed at the parent company level. But of course, needless to say that there's a close coordination that would be required with other authorities, and here particularly important are authorities in charge of data and competition. You could have MOUs, Memorandum of Understandings, that could be useful here to facilitate this cooperation. But in terms of the supervisory structure, no, you need to be indeed mindful that you truly reflect this cross-border dimension of BTFGs now, and here now we make the point that now for colleges you should make sure that you invite all sectoral regulators now from relevant jurisdictions. And this would ensure that you can exchange information and you ensure a certain consistency in terms of policy. So supervisory colleges could indeed be a foundation for this the cross-border supervision of a PTFG parent. And on a case-by-case basis, in these colleges, you should probably also invite non-financial authorities. And as I mentioned before, especially competition authorities, data authorities. But then there may be also other authorities that could be relevant, those for cybersecurity or data mobility or consumer protection. So this would also be needed to make sure that you reach a complete and comprehensive view of all the different supervisory concerns that could arise at the group-wide level.
Fernando, we have a couple of minutes left, but I mean, anything you wanted to add on the role, the responsibilities for home host regulators, especially when we look at non-financial regulators?
As Johannes described, I think that in terms of supervisory approach, our ideas actually go in the direction of saying that we have to ensure that supervisory framework is consistent with the type of regulatory framework that we are proposing. That's why we believe that we need some sort of a coordinating supervisor being able actually to particularly to monitor that the requirements to be imposed at the group level and imposed for which the parent company should be responsible. Those are actually properly followed and actually are applied across the whole group. So that is important. Beyond that, actually, what we have obviously is a number of regulators, both home and host, on different domains that will have actually to be obviously doing their business, and also they have to be properly coordinated. I mean, as you have seen in our framework, we feel that issues which have to do with conduct of business, which have to do with competition, may also be relevant from a financial stability point of view. And that's what actually sort of justifies that we need this coordinated approach. The idea is to have a supervisors that should actually look after the group as a whole, and then having mechanisms of coordination with different home and host authorities in different policy domains. So we believe this is a relatively complex framework, but at the same time, we feel that going beyond that would be probably politically unfeasible. So we have to rely very much on the current supervisory architecture and then try to ensure that this is fit for purpose when it comes actually to look after the requirements, the new requirements they want to impose at the group-wide level for BigTechs.
Wonderful. And with that, unfortunately, we're out of time. We have obviously talked about a lot of things today, but we've only just started to scratch the surface. So Still, we welcome our listeners to email us if you have any other questions or queries, and more importantly, to download and read the research from the BIS, as well as a lot of other research that's been going on. I wanted to thank our panel of experts for their insightful discussion. Fernando Restoy, Chair of the Financial Stability Institute of the BIS, and obviously a co-author of the report. Johannes, Ehrentraud, a Senior Advisor also with the BIS. Jamie Lloyd Evans, a former banker, regulator, and more importantly, a contributor to Regulation Asia, and Douglas Arner, Kerry Holdings Professor in Law at the University of Hong Kong. With that, thank you for everyone for joining our discussion. Thank you to our panelists. We look forward to speaking with you all again in the very near future. Thank you and goodbye.
Thank you.